All right. Hey, welcome and thanks for taking the time to dial in. I know several people contacted me this morning saying that they were headed to the field and would probably not be on live, so they said they would record later on. So today, what I want to do is kind of go high level and then drill down into time frames. I think there's lots of talk all the time about extreme moves, right? Extreme uh, fundamental events that could really move this market a long way either direction. So let's kind of talk about what those are, and then look at what the fundamentals or what the technicals are doing and telling us, because what they're doing is really lining up pretty darn well. And I'm going to start with the weeklies, and then we're going to drop down to the dailies, and I hope that it gives us a little bit of clarity on what this market is really trying to do. Okay, so big picture, right? You've got just increasing uncertainty and volatility in Russia and Ukraine. So huge growing region, and the unknown there is the list of unknowns is long. Can we get fertilizer? Can we get fuel? Can it get distributed? Can the farmers get the crops planted? Can they get them harvested? Can they get them moved? Um, and all of those questions are really unprecedented in the market. The market's never had to digest those types of questions before. So that's why you see wheat get just banged around, in dollar ranges, because traders don't know what to do with it. And then you have a decrease in the trading liquidity, which makes every move even more exaggerated. But what we're also seeing is the technicals are really actually holding up pretty darn well, as they've really began to absorb the changes in price and in volatility, and they've kind of come back and neutralized themselves. So with those events happening in the Ukraine, we've got a lot of volatility tied to those. But then you've got to add a very complicating factor, which is here and in South America, which is the weather, right? We've got terrible production. We've planted the fewest wheat acres we've planted in a long time, and our weather is really, really poor. So now I think, speaking to Kansas farmers all the time, I think it's fair to say everyone's going to plant a lot of wheat, but nobody has any idea what it might yield. So that increases the volatility and the uncertainty even more across the wheat complex. Now we start talking about corn, and you start talking about and you start talking about ethanol and fuel usage. You start talking about exports and the dollar. You add the Ukraine situation to it, and the volatility is to be expected. And the swings on the corn balance sheet could be really dramatic. Let me pull that up and show you what I'm talking about. We kind of went through this last week, right? But if you take corn and you assume that the USDA's numbers are right, which are right here, and we have a 1172, that's an 8.2% carryout. That puts us at fair value somewhere between 650 and 750. That's a pretty tight carryout, and we need to be high because we need to encourage acres and discourage any type of extra usage, right? We don't want to encourage any new usage at that tight of a carryout. But if fuel drops just just 6%, that's 350 million bushels of corn that doesn't hit. And if we don't have exports pick up, right now we're lagging 450 million below the current pace on the USDA. And now that takes our corn carry out to 14.7 on the stocks to use, or almost 2 billion. So now you're talking sub $4 corn again. So the corn market is really struggling between these two interpretations right here on the demand side. Where are we? And notice I held the yield at 171.9 or 172. So if the crop gets bigger, these numbers get much worse. If the crop gets smaller from here, which I don't think it's going to, I think the USDA has already trimmed it as much as they're going to trim it. Then these numbers, if it gets bigger, these numbers get worse. If it gets smaller and demand drops, they don't get much better. So that's why you keep seeing corn get smacked every time it tries to get near $7, because traders just can't really reconcile what this number's doing, because it is a fact and it is in the data that the fuel consumption is lower than it has been. So I hope that helps to explain why corn is doing what it's doing, because when we look at the chart, you'll see it, right? And let's start with corn. So this is the weekly chart of December corn, and we can see 1, 2, 3, 4, 5 weeks that December corn has tried to break above 7, and it just can't do it. And it makes sense if our carryout has a risk of jumping from 1.1 billion bushels to 2, then that's the difference between here and all the way down here, which is why we're so adamant that people be hedged, because this also correlates perfectly to this Fibonacci extension and retracement level off of this peak right here, which is all the way down here at 507 down to 472. So this is the range that we would expect corn to fall to if we roll over and break from here. Now it's not going to go straight there. It's gonna zigzag and it's going to give some opportunities to resell it. But overall, the trend may well turn lower from here, especially if oil breaks, and especially if that bearish case gets to be proven out in the economic numbers. So we are 100% comfortable being hedged here. And if it turns around and breaks these highs and takes us higher, we would love the opportunity to buy it again. But the reality is that for everybody that we work for, this is a lot bigger problem if we're not sold than a move higher, right? Because if it moves higher, hey, we still get to sell next year's stuff and whatever. And I know everyone fights it because our basis is screaming high. I mean, the stories we're hearing from the West are just catastrophic, right? $2.25 over the current board. That's an insanely good basis level, and it would tell you that we've got to go higher on futures. But we're not, because all that basis is doing is its job, and it's just reallocating the bushels back to the West instead of doing it in futures. Now, I don't know for sure that this is going to happen, because something could come in and China could come in and say, "Oh, hey, we need 15 million metric tons of corn." Well, if that happens, we're going straight to new highs. I mean, that's how quick we'll do it. Or Putin nukes Ukraine, we're going to go to highs if that happens. If either one of those occur, or if the Fed starts to drop interest rates again, and we say, hey, the consumer needs to spend money and we want them driving, well, that'll probably do it too. So that's 3 big macro elements that we have zero control over or ways to predict that would propel this thing higher. And the technicals reflect that as a potential, right? And they reflect it until we take all these lows out. So I think that what we've got to do is hold our shorts, hold the short positions that we're in, stay hedged, and just be prepared to re-own it if this high gets taken out. And then if we start to roll over more and we start to break down into the 650 area, then I think we need to start really looking at selling more into new crop, because I don't want to sit through 2023's production without taking. I don't want to sit through this move without taking some risk management steps on that crop as well. So we're looking at different strategies to put some protection on the board and not let that get away from us. But we don't want to be too early there either, which is why we're trying to back up and give that thing a little bit of room. So overall big picture, we're aggressively hedging and selling the 22 crop. we're starting to we're getting really close to pulling the trigger on hedging next year's crop, right? But we're going to let price tell us when to do it, and we're willing to sacrifice a little bit on New Year's on new crop in order to make sure that the odds are as in favor to us as we can get them. But for now, I think we sit on 23, and I think we hedge the heck out of 22 because the downside is very, very real. Now, what does the upside look like, right? Let's talk about that because that's way more fun. If the other wave count and the other stuff happens and we blow up into new highs, where do we count? Well, it's just ridiculous. I mean, think about it. 840, 844 as a beginning point. Most likely target would be 9 on futures, and you can't rule out a move to 1020. And I know a lot of people I talk to think that that's more likely than the other, which is exactly why we want to be hedged. Because when our farmers are that bulled up and people are that unwilling to sell into basis levels this strong, it makes me think the market might have to extract that pain before it takes any other bullish type of action. So we want to be hedged, and we want to make sure that we are protected. So if you haven't done it yet, make sure you talk to us about it. Now let's look at the daily chart. It's not quite as bad, but we have rolled over our primary hedge line, right? Make it really simple. We want to be hedged anytime we're below this blue line because we don't want that to happen, right? We fought this signal because we were too bold up the first time, and thankfully we've gotten all of that back, but we missed this move, and we're not going to miss the second one if it happens. I'd much rather miss this move a little bit back to the upside if we've got to go fill this gap or something before rather than miss this downside at this point in time. Okay, let's look at soybeans. Soybeans are not any more bullish, right? Currently our exports on soybeans are running 25% below what the USDA projected. If those numbers come true, then the soybean carryout will grow from 200 million bushels to 900 million. So that is a 700 million bushel swing, and it will oversupply the soybean market. Now, the bullish side is look at the biodiesel mandates. Look at the diesel shortages. Look how much bean oil we need to have in order to meet that coming demand. That's all true and accurate. That's absolutely 100% correct. But if we don't export it because Brazil did, then we don't need to go higher in price to maintain the supply that we have to have. So that's what this market is wrestling with. So here on this weekly chart, right, you can see what we're doing. We're right inside this cloud, and we are rolling right on over. And if this low gets broken, which is at 1350 on November beans, then look out below. I think we're headed straight to 1289, probably closer to somewhere in this $12 range. Let me put it on the daily chart for you so you can see it even more clear. We've broken all of our major support levels. We failed yesterday, and this is a major sign that we're now in a down move, because this sell-off that happened, when was this? This was on October 12th, this big up day where we failed and came back down. We failed at the 38.2% retracement of this decline. So we have this decline. We rallied back. We failed. That's counter trend move. We are heading lower, and this low is our target right back in here at 1287. Now, where does this count? If we put up our Fibonacci numbers, it actually counts to an initial point down here at this $12.90, $13 level, all the way down to 1201 and 1150. And friends, I promise you that if our carryout swells to 900 million bushels on soybeans, this is not going to stop it. It's going to head much, much lower to below 10 bucks. We're going to go all the way back down to cost of production if that happens. So the downside is very real, and we don't see anything on any chart that would tell us otherwise. It'd be way more fun to talk about this stuff, but moving it back to 16 because China steps in and buys them. But they haven't done that yet. and that's what it's going to take in order for us to rally this market and really put a lot of premium back into it. So we want to be hedged. We want to make sure that if we take this out, we're going to sell 23, and we're going to make sure that we are protected for these down moves that could be coming in this market. And nothing would make me happier than to reverse and take these highs out and have to change our tune and change our mind and say, hey, we got to look higher because of some development that has happened that we don't see today. Okay, I hope that's clear enough on those two. Now let's look at our friend wheat, right? A lot of you are planting wheat. We have no idea what our production is going to be, and this is a really, really tough one to trade because it's just getting whipsawed like crazy. This is our weekly chart. We've been looking at this area right here at $10 as resistance for a long time, and we did finally get it. And we did finally get back to it, and then we reversed from it with this big down week last week. Now look what we're doing this week. We took us to a new low, and now we've reversed it, and we've come right back up. Any more strength, and you have a hook reversal, which negates this week. So wheat is completely undecided, right? It's virtually at its midpoint from before the war to the largest panic. It's virtually, I think it's at 40% retracement is where this level is right in here. So wheat truly does not know what to do, and it's completely caught off guard. So how do we need to manage it? Well, this is what options are for, right? We need to make sure that we have sales in place or options in place that will allow us to capture the downside. Now, if we're going to sell calls, we need to manage those very, very tightly because the premium is high, which means that the risk is much higher. Earlier this week, a December $9 put, okay, we're trading at $9.50. A December $9 put, which is 50 cents out of the money, was half the price of a December $10 call. So you've got a 2-to-1 call skew, which is what that's called, meaning that the market is much more jittery of a higher move than it is a lower move. It thinks that the downside or the traders are discounting the probability of a down move against a higher move. So now, and that's also not a great time to sell risk premium because you can get smoked by that too. So the best play, honestly, is just to buy puts, because they're a little bit pricey, but they're cheaper than calls. It leaves your upside open and it removes your downside risk. I would buy them in December for the next 30 days, and then I'd go to March and I would just keep on building a floor and maintaining that floor out so that the upside is open, but our downside's protected. Because what's wheat going to do if corn breaks to $4 and soybeans break to 10? Well, wheat's not going to go to 14. Wheat is going to drop all the way back down to the $6 level and maybe worse if that happens. And what would be the fundamental reason that it causes that? Well, A, it would be Russian wheat comes out of Russia and enters world supply. B, it's the Australian crop is better or bigger than the traders currently think it is. C, it starts to rain in Argentina and it starts to rain here. Any of those things happen and wheat's going to drop out of bed really, really quickly, and you got to have protection underneath it because we're not going to have the time to do it once it starts. So that's my final comment for the week. I think we've got to make sure that we are in our positions and hedged early, because I think that when the market does recognize a bearish impetus, I think that it's going to fall really, really quick. Just based on the way it's traded. That's a gut feeling. I might be dead wrong on that, but I think we've got to be early to sell it and not try to wait and hope it breaks and then jump on it, because I think it might get away from us too quickly. So that's what we've been working to do, and we're going to keep working that way until something steps in and changes our mind and forces us to look higher. But for now, I think our trends are down and probably getting steeper. All right, I know that's bearish. I hate being bearish. I love to be bullish. but we just can't do that in good conscience today with the way we're set up and the way these markets are trading. So I hope next week we're saying, oh man, we were dead wrong, but something's got to change before that can happen. All right, I hope that's helpful. If that raised questions for you guys, or you need to talk through anything at all, please call us. We want to work through it with you and make sure you're in the best positions that we can be in. Remember, there is risk trading futures and options, and you should only do so in light of your own financial condition. I hope you guys have a terrific week. We will keep you posted on market movement through Facebook, and if you're not on TikTok and you want to, we are doing TikToks every day, just to try to increase our own awareness. So if you could follow us and like us on there, that we would appreciate that too. And don't be afraid to ask us questions in Facebook. The more questions and interaction we have with on our private page, the faster and more frequently those things are going to pop up in your feed as the Facebook algorithm picks it up. So please interact with us, ask us questions. We want to know what you're thinking, and we can't do that if we're not talking. So I hope you guys have a great week. I will talk to you next Wednesday.